Okay, well, good morning, everybody, and welcome to this latest instalment of our We're in This Together webinars, where I'm delighted to be joined by the team from Capitalise. For anyone that saw me speaking last week, I'm hoping not to be attacked live on air by the cat in this particular instalment, the sort of hazard I hadn't foreseen 9 months ago. So like me, for most people, most businesses, 2020's delivered challenges unlike any we've seen before. And as part of this series, we've been looking to help our clients with more than just their accounting and tax advice. We've been speaking with experts in the fields from HR to IT to legal and much more to share insights to businesses and how they can weather the storm and come out of this pandemic stronger. So for a bit of context, I wanted to share some stats with you from research recently conducted by the consultancy group Gallagher. The research was conducted to help understand the main concerns of business leaders following COVID-19, and 63% of executives interviewed said they were expecting an increase in bad debts due to the pandemic. 30% say customer insolvencies are now a major threat to their business, and business decision makers are also concerned about the impact of supplier chain insolvencies, with 28% saying these are also now a major hazard to the success of their own business. From our own experience, we're seeing similar trends in certain sectors, and that's a lot of additional strain that businesses are under. Now, sometimes the traditional ways of recovering these debts simply don't work. They're too slow, cumbersome, or expensive, which is why we've partnered with Recovery, an easy to use, quick and effective way of recovering troublesome debts. So Recovery is brought to you by the Capitalise team. And looking at the attendee list today, I can see that some of you will have used the Capitalise platform in the last 6 months or so to access their panel of lenders for the coronavirus business interruption loan scheme, or perhaps the bounce back loan scheme. Capitalise have been a brilliant partner for Ecovis to work with, and I'm delighted to be able to hand you over to their team, who will give you a quick overview of how the funding market currently looks, followed by an introduction to how the Recovery product works and when you might consider using it. If anybody has any questions they'd like to raise on this, please feel free to add them to the chat bar or message me directly, and we'll try to field these at the end. So free from any cat-related incidents that I can see, and without further ado, I'm very pleased to introduce you to Kaylee, Kip and Will from the Capitalise team. Over to you guys.
Amazing. Thank you very much, Ben, and good morning to everyone. So as Ben said, Capitalise are a capital advisory platform, and we've partnered with Ben and the team ultimately so that you have access to over 100 lenders, as Ben said, including those that are offering the government support, as well as access to debt recovery and dispute resolution. So who are Capitalise? As I say, essentially got access to those two main products. We've been around since 2016, and so far we've helped raise over £250 million for SME businesses across the UK. So starting off today, we're going to be joined by Kip Noble, who is our head of lender relations, and he's really just going to take the opportunity to talk through kind of the lending market at the moment and what's still available to you at this time.
Yeah, thanks very much, Kaylee. So what I like to do as a bit of a sort of intro and beginning to sort of where the lending market is just provide a little bit of a snapshot around sort of what we've all been through sort of over the last, 7 or 8 months. So it's nice just to take a bit of a breath and just realise that actually what has happened has only been going on for 7, 8 months. It feels like an absolute lifetime we've been in this situation, but it has actually been a lot shorter than probably most people realise. So if we think back to sort of, January, February, early this year, if we can sort of remember that far back, we had an incredibly open lending landscape. We had over 365 active lenders in the market, new products, new lenders were coming all the time. There was a lot of positivity moving forward. Clearly, that all dramatically changed in March when we entered the first lockdown. It's important to sort of think about the first lockdown completely separately from this one, and I'll explain more in a bit. So when we first went into the lockdown, there was so much uncertainty in the marketplace. We simply didn't know what impact COVID was going to have on our lives, and clearly it's had a bigger impact than probably anyone could have possibly imagined when we were first told we were only going into lockdown for a few weeks, and it got inevitably extended. So at that point in time, the lending market completely and dramatically changed. So lenders do not like uncertainty. It makes it nearly impossible for them to accurately price risk and therefore to lend appropriately. So at that point, they sort of retrenched from the marketplace. So we went from 365 active lenders to virtually none. And the government really had to immediately step in, and they did. So they changed what used to be the enterprise finance guarantee into CBILS. Now, they did this incredibly quickly. Clearly, there were some teething issues at the beginning. The only lenders in the marketplace who were able to provide it were those already on the BBB scheme, which were mainly the high street banks and some of the local enterprise partnership funders who just aren't really set up for high volume access to debt. So it caused a real panic in the marketplace. I remember at Capitalise, we had hundreds of applications come through for businesses just desperate for funding, and just the banks simply weren't able to process it, understand it, and put things through on time. So there was a real sort of panic in the marketplace. Luckily, gradually, the number of lenders within CBILS has increased. It's gone from what was about 15 originally to well over 100 now. The marketplace has really, really opened up. There's near full market access again for those businesses looking to obviously get funding. So it's a real change in landscape to what it was originally. It's much more open. Along that route, the bounce back loan schemes reopened, and alongside that, as I'm sure your accountants and advisors would have gone through, all the grants, the furlough scheme, which has now been extended, the self-employed income support. You know, we had the ETAL to help out, VAT changes, stamp duty, further grants in November, debt freeze on the personal side, mortgage repayment holidays. Everything like this has come through. There's just been a vast amount of support out there. So it's really, really important to look obviously beyond the government support and have a look at seeing what's out there, because there is a huge amount of support for businesses which are clearly struggling at the moment in this difficult time. So as we've sort of moved through, clearly in the last week we've gone back into lockdown, or 2 weeks ago nearly now. It's really important to sort of understand that this lockdown is completely different to what it was in the first lockdown in March. Construction is still open, manufacturing is still open, people are still going into the office, valuations are still able to take place, all the things like this are still open. So, and it's an important point to note that not a single lender has retrenched from the marketplace, changed their sort of sector policies or appetite. It's remained exactly the same as what it was before this second lockdown came into place. So they have the support network in place. CBILS is still very much open. So is bounce back loan schemes. So important to understand this in the context of where we are, much more open in terms of the lending landscape. So we'll go on to the next slide if you can, Kaylee, and I'll just run through the various products that we have. So the bounce back loan schemes, which has had a huge uptake in the marketplace. If we put it in perspective, there's been over 40 billion of debt that's been provided through the bounce back loan scheme, and that was provided in about 4 months' time. And just through that scheme alone, that is more than the average funding for the entire SME marketplace. Banks have provided 5 times more debt in the 6 months since CBILS and bounce back loans opened than they have in a normal funding year. It's been quite incredible the amount of liquidity that's been put into the marketplace through these schemes. So within bounce back loans, there are about 30 lenders in the marketplace, up to 50,000. You can only have it once and only once per group. So whilst it is very quick, very efficient, you can get it quite often within just 24, 48 hours. It's just a self-declaration and it's exceptionally cheap at 2.5%. It is quite restrictive in that quite often 50,000 is just not enough. The only reason really the bounce back loans were ever put into place with the 100% government backed guarantee was because of the length of time it was taking for CBILS to come through in the marketplace and people to get funding. So the government was under huge amounts of pressure just to release as much money into the marketplace as possible to ensure there weren't a huge amount of liquidations, administrations of businesses. It was a real panic move, but it's produced and probably kept a lot of businesses, actually surviving. So it's important to now have a look and really think and understand around, is that bounce back loan enough? Were you knocked back from the high street banks when you originally applied back in March, April? It's important to look at it now with the lending landscape being far more open. CBILS is much more open. We have a near 80% offer rate at Capitalise for all applications that we're seeing in by our accountants. So there are offers out there. So it's important to have a look now because there's still that uncertainty. We're in a second lockdown. It's taken longer than probably most people realise, and the impacts are probably longer. It's also the most incredible product in the marketplace that, you know, we'll ever see in our lifetime. It's a complete win-win. It's a case of why wouldn't you take or apply for a CBILS? You know, if you could, you can just simply put it into your bank account. If you don't need it, in 11 months and 30 days, you can repay it at no cost or charge whatsoever. So it's an incredibly, it's just an incredible product. It's a complete win-win. So CBILS up to 5 million, no personal guarantee whatsoever on debt up to 250,000. You can have it across multiple lenders. And it's across all product suites. So it's not just a term loan. You can have it across invoice finance. You can have it across revolving credit facilities, asset finance, and as well secured. So it's a really open product. And again, if you've taken a bounce back loan, you can still apply for a CBILS. You just have to refinance the bounce back loan. Lots of other routes into market for this one. So it's a really, really useful product, and I'd recommend everyone has a look and just sees exactly what they can do with it. And we're happy to answer any questions, you know, as we're going along or at any time whatsoever after the webinar. It's a really, really unique product. I can't recommend enough that you look at it. If you've already looked at it, look again. And then the commercial lending landscape, like I say, it is back open. However, it is slightly restrictive in terms of what they sort of can do in the marketplace. So that working capital, you know, unsecured debt is now 100% dominated by the bounce back loan CBILS market. Those alternative lenders, that they simply can't compete with the non-PG pricing that is being put into place by the government schemes. So realistically, where we see the commercial lending landscape, secured finance, so corporate finance, you know, M&A, we're seeing a huge uptake on. We're seeing a massive uptake in sort of property development, buy-to-let, commercial investment, that side of the marketplace, just because a lot of companies now have this extra liquidity, which they're utilising for business purposes, just to potentially grow or buy a development or a buy-to-let or whatever it might be in the marketplace. And another product which we've also seen an uptick in is invoice finance. So the reason probably why all of these are coming into place is just lenders are much more cautious now of looking at secured finance. So that unsecured marketplace is slightly difficult because, again, like I say, it's dominated by those two schemes. But overall, the lending landscape is a lot more active than it was. So you should have a bit more confidence in the marketplace where it sits right now. So if you could just jump onto the next slide, Kelly. So just some key updates that have come through on the two schemes. So the deadline for CBILS, bounce back loans, and everything else seems to sort of get pushed and pushed back. So obviously we had the initial September deadline, which the government really liked to leave it until the last minute, and then decided to extend it to November. They've given a little bit more forethought into it now, and they've extended it obviously now to the end of January. So that's for all applications into the lenders by the end of January. Again, I think we need to just stick with the fact that this is the new deadline and just apply it. So it's important to note that obviously we're coming into the Christmas period. A lot of businesses shut down. A lot of these lenders will also have reduced capacity. And then January is tax season, which is for accountants an exceptionally busy period. So if you are thinking about CBILS, which I strongly recommend, it's really, really good idea to start thinking about it and look at it now. I really would not leave it until December or January, especially as the lenders will also be exceptionally busy. So just a bit of an important point there. And then the bounce back loan scheme has evolved. So it's now termed as pay as you grow. So terms have increased from 6 to 10 years. So you can speak to your lenders around that. If you've already taken a bounce back loan, you can now get interest only periods up to 6 months and repayment holidays as well up to 6 months. And lastly, what was announced a few weeks ago was the bounce back loan top up, whereby if you've already taken a bounce back loan, but it wasn't quite up to either the 50k limit or the 25% of 2019 turnover, you can go back to that lender and request a top up to the maximum that is allowed for your business. So just a nice little important point for that one. And then lastly, along CBILS, they intend to increase the term up to 10 years. This hasn't actually been formal policy, but it's something they're looking at and discussing in terms of process. And the rationale and reason for all this is that the government and everyone else is very conscious that we're in about sort of 6 to 9 months time, we're going to get a period where all this debt will start to be repaid, and it's going to be quite in cash flow intensive for a lot of businesses. They're trying to ease that pressure by allowing these sort of repayment holidays, increasing terms, which reduces the monthly repayments, and just ensuring we don't suddenly get to a point in a year's time where businesses again are struggling with all the debt that they've had to sort of take on board for CBILS. But again, like I say, it's just so worth applying and having a look at, because like I said, if you don't need it, you can repay it within 11 months. There's no cost whatsoever to the business. It's no arrangement fees, no cost through Capitalise, and everything for the first 12 months. So it's just a phenomenal product, which I think should be fully utilised for every business in the marketplace. And that is, I think that's me, Kaylee. So yeah.
Amazing. Thank you very much, Kip. So as Kip kind of said, debt is definitely one way of kind of injecting capital into the business. And the flip side of that is very much getting the money that you're owed due in, or going back and collecting kind of those amounts that you've written off previously. So going to hand over to Will, just to introduce recovery to you.
Thank you very much, Kip and Kaylee. So we'll start with why is it we're talking about recovery today, and I'll start with some statistics. So we've got and I'll just add that these statistics were made 12 months ago. So we'll start with 42% of SMEs fear that payments put their businesses at risk. We'll then add that 48% of invoices issued by small businesses in the UK are paid past their due date. So we start to see that businesses like yours can be fairly at risk and in a fairly vulnerable position. We'll then add the box in the bottom right that 96% of SMEs regularly experience bad debts or commercial disputes. And 89% of SMEs will not instruct a lawyer when faced with a dispute. So we've got businesses in a fairly vulnerable position, and we've also got businesses that don't particularly want, or they're not that forthcoming in looking for help in solving those positions. We then add into the mix the pandemic that we're in, COVID-19. KG, if you can move over. So, like I said, we've got businesses in a fairly vulnerable position 12 months ago, and then we add into the mix coronavirus. And as you can see on the graph there, coronavirus has increased the time taken to pay back in May by 26%. And I'll just add there that that's back in May. I imagine if we had the data up to today, that number may well have increased. I'll also add that the credit management group found that around 80% of UK businesses have accepted longer payment terms than they're comfortable with. You then add the statistic that we just saw on the previous slide, that 42% describe late payments, putting their potential future business at risk. We don't start to paint a picture of a particularly healthy place that businesses are in. We'll go through a case study where a business has found themselves in kind of this position, and I'll move over to you, KG.
Yeah, absolutely right. So I guess, yeah, key things from what Will said there. Ultimately, 96% of businesses like yourselves are going to experience a bad debt or kind of commercial dispute at some point, and actually statistically only 11% of you will go and engage that help. And the story I'm kind of going to tell now really highlights the benefit of kind of speaking to your accountant about this earlier and in kind of getting that help in as soon as possible. So in this situation, we had an accountant refer a client to the service. They were a building contractor and they were struggling with an unpaid debt. So the debtor was kind of having various internal complications, and this building contractor had chased this debt on multiple occasions, and despite kind of lots of back and forth, the amount owed eventually got up to £120,000. So the building contractor themselves owed £30,000 to a large corporation, but actually due to the fact that they were owed this £120,000, they themselves were unable to settle that £30,000 debt that they had. And so actually what happened is that the large corporation decided to file a statutory payment demand, which is the first step towards kind of a compulsory liquidation. And because this building contractor wasn't able to make a repayment, they were pushed into that liquidation, which ultimately kind of encompassed the 120 that was owed to them as well. And so the real kind of point of that story is that actually if action had been taken quicker, those funds could potentially have been recovered. And actually that building contractor would have been trading with kind of plus £90,000 of cash flow in their bank account. And actually, as it currently stands, they have no business. And actually the Escalate service that we offer weren't able to take any action because of that liquidation. And so really, really difficult situation where it really is just a case of getting ahead of that, getting that help in as soon as possible, and potentially that can save businesses. Amazing. So as I say, only 11% are actually getting that help in, but Will, do you want to chat through kind of why actually businesses don't go ahead and pursue that action?
Yeah, absolutely. And I said statistically that 89% don't. And definitely that business you just talked through can relate to some of these. I think the 4 key ones that maybe you can relate to are that legal action is just too difficult to justify, and we're not sure that we're going to receive the payment anyway. It can be too time consuming and cost prohibitive. We don't really know how to go about it, and without developing a bad reputation. I think that's quite a key one. But I think what most businesses can probably relate to is the cost factor. So of an average £2,000 invoice taken to court, it would typically incur costs of £5,000. Where those costs would amount would be through legal fees, court fees, potentially disbursements, and so you're fronting those £5,000 before you even make a recovery. Then, if you don't make a recovery and the defendant wins, you're then potentially picking up their legal costs, court costs, etc. So like I said, it can be a really expensive and therefore painful process with no certainty of winning at all. And I think we're now finally at a stage where we can stop talking doom and gloom and move into the solution. Kaylee.
Absolutely. I think, as Will said, we've painted a pretty dim picture so far, but it's not all bad news by any means. Actually, what we kind of came to from all of that information is that there was space for a service that would really be focused on you guys as business owners, and how we could kind of help you with this process. So ultimately, to do this, Capitalise have teamed up with a best-in-class legal firm, Escalate. They are award-winning and have actually collected over £100 million for clients already. So this partnership was created by kind of looking at each of the steps of the kind of traditional dispute resolution process from a client's perspective, and looking at ways of improving that. And the result of that is kind of a completely new approach that focuses on your business's cash flow. So this service is a no-win, no-fee situation that focuses on quick settlement, but actually Escalate also have the ability to take these things all the way to the High Court if needed. And in this service, you are getting a dedicated team of top professionals. So that's corporate recovery specialists, that's litigation lawyers, that's sector specialists, that's our team on the Capitalise side, all working together to support your business through this process, and ultimately make this as kind of smooth sailing as possible for you, whilst also aiming to ultimately get the kind of duration of this process reduced by kind of 50% against the traditional approach that people have seen. Amazing. So in terms of that process, along the bottom of the screen, you will see kind of a timeline of what happens. So collect refers to kind of you as a business going out and trying to get this money back, chasing it yourself, and going through your own processes there. The referral piece is very much when you go and speak to your accountant about this bad debt, and actually they refer that into us and we start collecting that information. Engagement is when Escalate review the information that you have, and actually if they think, yes, this is something that we can take forward and recover for you, at that point they will issue you with an engagement pack. But actually, if they look at this information and they think, do you know what, we don't think that we can take this forward and we don't think that we'll be able to recover this for you, they will actually spend a lot of time coming back to you with kind of the reasoning behind that and giving you essentially free legal advice on how to alter your processes, your contracts, the kind of things that you have in place to actually prevent this happening again in the future. So lots of handy advice from those professionals that I mentioned earlier. So then negotiation is when Escalate kind of start their process with the bad debtor. So they will issue kind of initial contacts, let them know who they are and give them the opportunity to respond as they see fit. And then litigation is what follows. So if the debtor gives no response, Escalate will ultimately start preparing their legals, and you will absolutely be given the opportunity to review this information before it moves forwards. And at that point, they will then look to push that forward to the courts to get a judgment. The courts will then obviously take that forward and make a decision, hopefully in your favour, at which point you will see kind of funds coming back into your business, which is the kind of ideal outcome of that. And then, as I mentioned earlier, it's a no-win, no-fee situation. So actually, if it gets that far and the courts rule against your business, kind of against Escalate's arguments, then ultimately you haven't paid anything at all. But as I say, in best case scenario, they'll be recovering those funds and you'll be getting that kind of capital injection back into the business. So, Will, do you want to chat us through what debts can be recovered?
Yeah, absolutely. So we'll start top left. So invoices or contracts need to be above £1,000. If you've got multiple invoices with one single client, we can effectively tie those together if they amount to over £1,000. The contracted party has to have the ability to pay. If there's a shell of a company there, or it's already gone into liquidation, and there's just no funds available to be recovered, we're at a loss, really. There's nothing we can do. Your business needs to be a UK-based trading entity, but I will point out that the bad debtor can be from abroad, and that's absolutely no issue. And again, there's no extra cost for that. The debt can be written off in the last 3 years, so you can actually go back into the last 3 years of accounts to see what you've written off, to see if there's anything in there that's worth going for. Couple of housekeeping points that Capitalise have put in place. We expect it to be a position where you've already attempted to collect the funds yourself. So you've already chased it multiple times. Maybe you've even entered commercial discussions as to try and work out why it is that the other party isn't paying. And the last point in the middle there is SME does not intend to continue working with the contracted party. We have had multiple situations where there is an amicable relationship after the recovery, but there is quite likely that the other party may not be best pleased that third parties been involved to recover in the situation. So just be wary that is a possible and potential outcome. And we'll finish hopefully on a positive case study. But it was quite a difficult situation. We're going to talk through. It was a PR company who was selling their company. Total sale was £325,000. It was going to be sold in three stages. So sorry, payment would be taken in 3 pages, weighted at the end. So the final instalment was going to be £250,000. The final instalment didn't ever come through. The entrepreneur turned around to the parent company and said, tried to work out what the issue was, what was going on. And the parent company said, actually, there's been a breach of contract here. We don't owe you the final instalment. So effectively, the parent company has bought a particularly cheap company. The entrepreneur went and sought legal advice, and the legal advice actually ended up amounting to £20,000, and no progress was made at all. The entrepreneur finally turned around to their accountant and said, look, this is the situation I'm in. It's just gone from bad to worse. What can be done? The accountant turned around and said, look, we can engage a last action and talk to Escalate. Escalate went through all the contracts, said actually this is a legally solid contract. There's no reason why it should have happened. They pushed through, took it to court. The parent company actually took lots of different ways in which to slow down the case, not being aware that it was at no cost to the entrepreneur, and it ended up that the full funds were recovered. Actually, the business ended up, the parent company actually ended up spending £450,000 because of their own delay tactics, and the legal fees that the entrepreneur amounted of the £20,000 were also recovered. And why that's possible is because of Escalate's no win, no fee, and there's no risk to the client. There was no they couldn't be bullied into settling early and amounting costs that they couldn't afford. Escalate was stumping all those costs, so they were put in a position where they were comfortable and in a strong enough position to stand strong and push it through court. So hopefully, we've ended on a high there, and I'll pass back over to Kaylee.
Absolutely. Thank you very much, Will. Definitely a more positive story at the end. But in short, from our side, Ben and the team over at Ecovis absolutely have the ability to access these services and help you with these things. And so our kind of ask is really just have a think about the things that kind of we've talked about today. And if there's anything of interest, anything you want to discuss in more depth, please don't hesitate to reach out to Ben and the team to kind of pick up any questions and pieces there. But on that note, I will pass back to Ben to field any questions that we might have.
Okay, brilliant. Thanks, Kaylee. And thanks to all of you for taking the time to run through the platform with us. As mentioned earlier, I love the way these tools are so easy to use, and they really do take a lot of the stress and the admin away from users, both on the loan and the debt recovery side of things. And for all of our clients on the call today, I'd certainly echo Kaylee's sentiment that for all of these things, don't sit on your hands and act sooner than later. So I did mention that we might have time for a little bit of Q&A, and I can see a couple of questions have come over to me. So if I read them out, I'll let you guys battle it out as to who fields them. So the first one, we've got one coming through on the chat function from Daniel Smith. Good to see you today, Dan. Thanks for joining us. Pretty much straight at you, actually, Kip. On CBILS, there are strict guidelines on the balance sheet, including brought forward losses and or share capital. Sorry, are there still strict guidelines? So I guess in this instance, Dan's talking about the EU state aid law, which had to show they weren't undertaking in financial difficulty as of December 19. So this has changed a little bit. Do you want to pick this one up, Kip?
Yeah, absolutely. So it has changed. It changed as of August. So now it's no longer applicable, basically. So if you do have losses that have been brought forward, you have a negative balance sheet, it won't adversely affect your CBILS application. The only point is that it must be still a viable business. So the only way it sort of is now sort of changes is that, yes, these are sort of for businesses that might have had, say, huge amounts of capex, initial investments where they, were loss making initially just for that high growth. However, it still must be a viable proposition in 2019. That is the key year. So as long as by 2019, during that calendar year or financial year, they made a profit, they should be able to get CBILS. And I do stress should. Clearly, we need to understand more around the business. But 2019 is the key year. So even with a negative balance sheet, losses brought forward, whatever it might be, as long as it turned that corner and hit profitability in 2019, it should be able to get CBILS.
Okay, thanks, Kip. So just to elaborate on that question a little further. So for any of those businesses that applied for CBILS quite early in the process, before this kind of change in the rules, would they be eligible if they were to then reapply later on? Are they able to do that?
Yeah, absolutely. They can reapply. Generally speaking, most of the lenders need 3 months from the previous application to now. Sometimes you can push it through with various lenders, but generally speaking, 3 months is usually the minimum that a lender needs to relook at an application. So hopefully that will still enable them to apply, but obviously that we'll need to sort of look at it on a more individual basis.
Okay, brilliant. Thanks for that. So we've actually got a couple more questions through on the CBILS side of things. So I don't know if that's best for you as well, Kip. But the first one, at the moment, how long does it take to access funding? What's the sort of lead time on these at the moment?
Yeah, really good question. That so two very distinct timescales. You got the high street banks where it's anywhere between 2 weeks and 2 months, if we're being honest, and that varies between, do they have a dedicated relationship manager? If so, they can apply directly with that relationship manager and quite often get funding in place, within a week or two. However, if they are, and unfortunately what most SMEs are now, is just on a call center or whatever it might be, yes, they can come through Capitalise, through yourself. However, the timescales, if they are looking for high streets, they can be quite extensive, just because it unfortunately sort of sits in a bit of a queue before it gets looked at, and they do have a bit of a backlog, although I have to say it has eased as the number of applications going to high street lenders have decreased. But I set expectations around the 4-week mark for some sort of turnaround for those transactions. And then the alternative lenders, which we've got excellent relationships with at Capitalise, that can be anywhere from sort of 3 working days up to 7-10 working days. That's from receipt of all the information and application being sent into the lenders. So yeah, between sort of 3 and 7 working days, I'd say would be a good guide for those alternative lenders.
Okay, excellent. That's pretty impressive actually from that alternative panel in terms of the turnaround time. Which may link to the next question that's come over. My bank has declined me. Will someone else approve? Are there differences between lenders?
Oh, very much so. So the high street lenders, I mean, I used to work for Lloyds Bank in mid-corp, so I know it well. And I know obviously Kaylee was previous NatWest as well. So yes, they look at it on a very different basis. They are very old school. They will still look at pure serviceability. So it needs to fit their criteria, and their criteria simply is stricter. So yes, if you have been declined by the high street bank, as long as, like I say, you were profitable in 2019, that again is a real key caveat, then yes, you should be able to apply to alternative lenders. And like I say, we have a near 80% acceptance or offer rate from applications coming through accountants to these alternative lenders. That's how open it is. So yes, if like I said at the beginning, if you've gone to these high street banks, your main banker, and they've declined you right at the beginning, a lot of that sometimes is to do with they didn't really understand the process, the risk and what the model was, but also they do have much stricter criteria. So if you have been knocked back by the bank, I wouldn't worry too much. There is still the alternative lending market, which is now very, very open for CBILS. So it is really worth reapplying and certainly looking down those routes. Okay,
that's brilliant. Thanks, Skip. Really, really useful. Hopefully useful for the guys attending today. So the next question, possibly one for yourself, Will. It's a recovery related question. Can recovery be used for rent arrears? I'm not sure if that's for yourself or Kaylee.
Yeah,
Will, do you want to pick that one up?
Yeah, absolutely. Question we get asked a lot. And the simple answer is yes. We get quite a few through landlords, both individuals and companies can use that there. The time frame is slightly different for an individual. A company takes slightly longer going through an individual. They're just given more time to come back at all stages going through the process. But like I said, very easy question. You absolutely can.
Okay, excellent. Well, hopefully that helps cover that one. So I'll just have a quick look in the chat, because I think that's all the questions that we've had coming over. Yep, I think that there was a follow-on from Dan, but I think you've covered that, Kip. So, okay, well, yeah, brilliant. Thank you guys so much for sharing your time, your insights and your expertise with us this morning. For anyone attending the call that is interested in following up with either the funding or the debt recovery side of things, please just pick up the phone to your Ecovis manager or partner, and we'll be delighted to help you out alongside the Capitalise team. So thanks once again to all of you for attending, and for our brilliant panelists from Capitalise. Have a great day, and do remember, we're all in this together, and we look forward to seeing you at our next webinar. Have a good day. Thanks.
Thanks, everyone.